Chuck Carnevale. I'm the Chuck in the Markets Upcheck, and today's blog was titled "One's Pain, Another's Gain." And the reason I did that was I wanted to point out once again that this really is a market of stocks, not a stock market. Family Dollar is a retail chain that has been known for its low cost. It runs kind of a self-service, low overhead retail store that's and therefore offers very low prices, and it's a company that's really proliferated extremely well during the recession. As you can see here, earnings per share for this company have been very consistent for a long period of time. This is a 20-year chart. They did have a little softness in 2008, but this year, as the end of 2009, which ended October 31st, they showed a 25%, 24.7 to be precise, increase in net income, which is excellent considering the depths of the recession. The company has very little debt on the balance sheet. So when you look at this, you can see that from an operating point of view, it's a very healthy company that has done extremely well and held up extremely well right through the recession. When you're being priced into the equation, you can see that there's been times where the market has really been in love with this company, where they've had the stock value significantly above earnings. The light blue area shows the dividends they pay out of earnings. The company has a 1.8% dividend yield. It's currently priced at a very attractive valuation relative to its historical norm. It's very rarely ever been below its earnings line, as it when it got that way in March of 2008. Of course, it had a strong rally. It's trading at about 13.8 times earnings with a 1.8% dividend yield. If you look at its long-term record of dividend growth, it's really has an excellent record of increasing dividends in most years. There's one year where they did modestly cut the dividend, but you can see the dividend has expanded significantly, since 1991. I also want you to notice that a $100,000 investment in this company would have averaged about 15.4%. That's, not quite 3 times, but certainly over twice what the market was able to generate. And of course, look at the difference in return. The market doing 6.4% as measured by the S&P 500 turned 100 into 319,000, where $100,000 in Family Dollar would have grown to $1.4 million. So what you have here is another example of a market of stocks, not a stock market. Even on a price-to-sales basis, I want you to notice that this company is trading at one of its lowest price-to-sales that it's ever traded at just under 0.5 times sales, and also based on its forecast to continue to grow at 12 or 15%. After today's report, that forecast might actually be increasing, and so it's selling at a discount to its fair value also, at least based on these charts and fundamentals. As always, I encourage you to do your own homework, but this would be a candidate that someone who's looking for a little bit of some nice growth, above average growth, and decent dividend income might want to look here. Again, do your own homework, but based on the fundamentals, Family Dollar looks good here.